You know that $34 trillion national debt everyone pretends to panic about? The one politicians use as a prop during election season. Here is the quiet part out loud. That debt is not an accident. It isn't a bug in the system. For the top 0.1%, it is a feature. It is a purpose-built mechanism designed to inflate assets and dilute the wages of everyone else. Welcome to History's Wallet. While Congress argues about budget deficits on TV, the ultra-wealthy are quietly positioning themselves for the inevitable cleanup. See, most people treat the economy like the weather. It's just something that happens to them, and they hope they brought an umbrella. The elite treat it like a casino where they own the house. They know the math is rigged, so they bet on the rigging. If you enjoy financial history lessons that actually explain how money works, hit like and subscribe to support the channel. Today, we are going to reverse engineer their playbook by looking at two investors from 2008. Richard, who followed every rule and got crushed, and Frank, who ignored the rules and got rich. We need to understand exactly how the game is played before the next cycle breaks. Let's start with the victim. We'll call him Richard. Richard is the archetype of the good employee. He worked at a manufacturing plant outside Cleveland for 30 years. He listened to HR during orientation. He read the brochure with the smiling couple walking on a beach. He maxed out his 401k, took the company match, and believed the most dangerous lie in finance: just buy and hold. He drove his cars until the wheels fell off and brown bagged his lunch for 2 decades. By October 2007, Richard had nearly $900,000 saved. He was a year away from retirement. Then the financial crisis hit. In 16 months, nearly half of his life savings evaporated. Richard didn't lose that money because he was stupid. He lost it because he was exposed to sequence of returns risk. This is the boring technical term for a financial death sentence. Wall Street loves to tell you that the market returns 8 or 10% on average. That is a beautiful statistic that means absolutely nothing if you need to withdraw cash during a crash. If you lose 50% of your portfolio the year you retire, the average recovery doesn't matter. You are selling assets at a discount to pay your electric bill. You are cannibalizing your own future to survive the present. To get back to, even after a 50% loss, you need a 100% gain. Richard didn't have the time for that math to work out. The financial industry loves to sell you the average. They wave charts showing that the market always goes up in the long run. But you don't live in the long run. You live in the monthly bills. While the market eventually recovered, the retiree who had to sell shares for cash did not. Richard opened his quarterly statement in early 2009 and his hands shook. The money he planned to use for travel and spoiling his grandkids was gone. The psychological pressure of a crash is specific and targeted. It convinces you that the world is ending exactly when stocks are on sale. The industry tells you to stay the course. That's easy to say when you are 30 and have a paycheck. When you are 60 and watching your nest egg vanish, staying the course feels like staying on the Titanic because the captain says the swim to New York is good exercise. Richard panicked. He sold at the bottom. Not because he was weak, but because the system is designed to induce maximum panic in the working class right before the recovery starts. He locked in his losses and spent his retirement relying on Social Security. Richard was playing checkers. His neighbour, Frank, was playing 4D chess with the Federal Reserve's money. Frank was the neighbour who drove a 5-year-old truck and seemed suspiciously calm when the headlines were screaming about the end of capitalism. While Richard was staring at his 401k balance like it was a ticking bomb, Frank was looking at his war chest. Frank understood something that the Richards of the world miss. A recession is not a natural disaster to be feared. It is a going out of a business sale for the American economy. He viewed the stock market like a luxury outlet store. When prices are high, you window shop. When the store catches fire and they are selling inventory for pennies on the dollar to pay their debts, you bring a moving truck. But to do that, you need the Vulture's Handbook. It relies on 3 specific levels of defense that work in unison. Level 1 is liquidity, or the oxygen. Frank refused to be fully invested. He kept roughly 20% of his net worth in boring, unsexy cash equivalents. This is the hardest discipline to maintain because in a bull market, you look like an absolute idiot. Your brother-in-law is bragging about making 30% on tech stocks, while your cash is earning 4% and losing value to inflation. The financial industry calls this cash drag, and they shame you for it. They tell you that time in the market beats timing the market, which is a catchy slogan designed to keep your money collecting fees in their funds. Frank ignored the shame. He knew that liquidity is the oxygen you need when the air gets sucked out of the room. When the credit markets froze in 2008, Frank didn't have to sell a single share of his long-term holdings to pay his bills. He had a moat. Level 2 is psychology, or the stomach. This is where the math stops and the biology begins. When the market drops 40%, your amygdala screams that a predator is chasing you. It triggers a fight or flight response that usually results in hitting the sell button at the worst possible moment. Frank wired his brain differently. He didn't see his net worth dropping. He saw his yield percentages rising. If a solid company pays a $2 dividend and the stock price is $100, that's a 2% yield. If the price crashes to $50, that same $2 dividend is now a 4% yield on new money. Richard saw his life savings vanishing. Frank saw his income doubling. Level 3 is aggression, or the falling knife. This is the mechanical execution of buying when it feels like the world is burning. You cannot rely on your intuition during a crash, because your intuition will be screaming, "Run." Frank used a predetermined schedule. He wrote it on an index card taped to his desk. Mark it down 20%. Deploy 25% of the cash reserves. Mark it down 30%. Deploy another 25%. Mark it down 50%. Empty the clip. He was catching falling knives with Kevlar gloves, trusting the math over the mood. This strategy only works because of the debt connection. Frank knew the secret. The national debt forces the government to save the system. With $34 trillion in debt, the government literally cannot afford a deep deflationary depression. It would bankrupt the Treasury. Therefore, the Federal Reserve must eventually print trillions of dollars to bail out the system. That printed money flows into assets, inflating prices back up. Frank wasn't betting on the genius of corporate CEOs. He was betting on the government's lack of discipline. He knew they would debase the currency to save the bond market, and he positioned himself to ride that wave of liquidity back to the surface. Now let's shift to the present day. The indicators that flashed red before 2008 are flashing again, but this time the stakes are significantly higher. The casino is still open, but the lights are flickering and the smart money is heading for the exits. You don't need a Bloomberg terminal to see what's coming. You just need to read the rigged indicators that the 0.1% watch while everyone else watches the news. First, watch the SAM rule. This indicator tracks the momentum of unemployment. It triggers when the 3-month moving average of the unemployment rate rises by half a percentage point from its low over the previous year. It sounds technical, but it acts as the final warning bell. Unemployment is usually a lagging indicator. By the time it spikes, you are already in a recession. The SAM rule catches the turn early. We are flirting with these levels right now, suggesting the floor is about to drop out beneath the labour market. So how do you build a safe portfolio today? You don't dump everything into a mattress. You build a defensive fortress. You look at short-term treasury bills, which are currently paying you risk-free interest to wait out the storm. You look at dividend aristocrats, boring companies that sell toothpaste and toilet paper, businesses that have raised their payouts for 25 years through wars and crises. You build ladders of bonds so you always have cash maturing every few months to reinvest at potentially higher rates. First, look at the yield curve inversion. This is the bond market screaming that the economy is broken. In a healthy economy, you get paid more interest to lock your money away for 10 years than for 2 years. That makes sense, right? But right now, the curve is inverted. Short-term debt pays more than long-term debt. This happens when investors are terrified of the near future, so they pile into long-term bonds for safety, driving those yields down. This inversion has predicted every recession since 1955. It is the financial equivalent of the ocean receding from the beach before a tsunami hits. The bond market is telling you that the system is about to snap, yet the stock market is still partying like nothing is wrong. The next crash will be a massive transfer of wealth. It will move assets from the hands of the Richards, who panic, sell at the bottom, and rely on a broken system, to the hands of the Franks, who prepared, held cash, and understood that the national debt guarantees a bailout. You cannot stop the financial wheel from crushing the unprepared. The debt is too big. The game is too rigged. But you can choose not to be the roadkill. Subscribe to the channel, because in the next video we are going to break down the specific mechanics of Social Security timing, the other half of this survival equation. You cannot afford to miss that math.